You're listening to the Practical Wealth Show with Curtis May, putting you in the driver's seat to control your finances. Let's start the Practical Wealth Talk about alternatives to Wall Street.
Hey everybody, welcome to another episode of the Practical Wealth Show. So today we're going to talk about, and the title of this episode is, what do rising interest rates mean for you? And so this show was inspired by an article I read over the weekend by Garrett Gunderson, who's the author of one of my favorite books, Killing Sacred Cows. And, you know, it's funny, over the weekend I was at a real estate in Philly. It was like real estate week, and which is the brainchild of a great entrepreneur, Nicole Purvey, and hopefully I'm gonna get Nikki on my show in the near future. But anyway, I was talking to somebody there about why you have to think about economics is major, as Jim Rohn says, and you have to really kind of understand what's going on. So even though if you're focused, the asset class, like this was a real estate week, so most of them were real estate investors, developers, but that's just one asset class. And so I think that you need to understand what's going on so that you can kind of see how the winds are blowing, so you can kind of position yourself to affect you. So because when it comes to interest rate, according to Garrett's article, that, you know, we've been spoiled for a decade thanks to cheap federal funds target rate, everything from mortgage to business, auto loans, business loans, student loans that basically have been on sale. And I remember when I was in high school, I'm dating myself now, but in high school, freshman, sophomore year, you know, rates were 18%. I remember student mortgage rates were 17, 18%. I remember my dad introduced me to his banker, and I remember her telling me, hey, you should, start saving, her money market account. If y'all in Philly, it's First Fidelity, I think. Money market account was paying 21% interest. Can you believe that? Money market accounts pay maybe 1% now, but they were paying 21% interest. So even though mortgage rates were 17%, people were getting 15% on annuities, 7, 8% on CDs. So it's all relative, folks. And so even today, after 6 separate interest rates increases since 2015, rates are still only 4.5%. Think about that, right? 6 increases, and we're just up to 4.5%. And key economists, investors, and even President Trump sees interest rates rising in the next few years. And the latest report showed the Federal Reserve has 3 more rate increases that they plan this year, plus multiple increases through 2020. So brings me back to, what do rising rates mean for you? But, let's look at why they're rising. All right. And so here is the official reason why they're rising. So the Federal Reserve increases rates to keep inflation. This is their methodology, from getting out of control. So when they see economic growth and unemployment rates on the rise, and with an inflation rate of 2% a year, they generally, in their minds, start increasing rates, to kind of, what they're trying to do is to manipulate monetary policy to kind of affect the growth that they want. But see, here's the other side of that. So when you look at, so I was telling somebody this. So what happens is, if you look at here's the problem. And one of the things where the rates with nationally what they mean, and then let's bring it back what it means to you. So what did we just pass at the end of the year? We had tax cuts. So I'm all for tax cuts, right? And but it's hard to cut taxes. See, if you're going to cut your revenue, you need to cut spending. So you have to cut taxes and cut government spending, which is not what happened, right? So you cut revenue, you've increased government spending. And so we're borrowing some crazy number like, I can't even quote it, like $10 billion a month or something crazy like that. I have to look it up. So I don't have it in front of me right now. But we are, through military spending and this and that, we're spending way more money. So we didn't cut. We already had a deficit, right? So that means if you're going to cut taxes, then you have to borrow more money to keep the government open, because we have not cut government. And so now, here's the problem with the Fed raising rates. So the Fed has kept rates too low, too long. And so from the stock market perspective, we're in the longest expansion in the history of the stock market, right? And so you have raised rates at the end of a business cycle, according to David Stockman, and there is just not that much more runway to run. Nothing goes up forever. So all bubbles pop. We're in a bubble. Make no mistake about it. And so I don't care what your stockbroker tells you, And so what happens is you've got to see with your eyes, you got to see what's going on. So now markets are up. The taxes went down. So this allows the corporations to show more retained earnings. You're basically using the money to buy back more stock. So they're kind of, playing with the numbers to show better bottom line so they can boost their stock price so that they can engineer more money so the executives can create bigger pay raises for themselves. Not pay raises, but stock options. They'll exercise their options when the stock prices go up. Check out Why the Rich Get Richer. By Kiyosaki, you start to understand why, because I can never understand why the companies wanted to buy back their stock. I saw no economic, I didn't see any benefit for the company to do that, but now I get it. It's just a bunch of, playing money games, financial engineering. But here's the thing, before I go off on a tangent, when you're cutting, so now, the Federal Reserve wants to raise rates. Why do they need to raise rates? Because they need to be able to have some dry powder, as they say. So when the stock market crashes, they need to be able to, in their mind, lower rates again, so that they can get the economy going again. Well, you can't raise if they're at 0 or 1% or 2%. You can't do anything. And so you've got to systematically increase them so you can create the illusion that we have a healthy economy, and so you can lower them back down again, right? And so, but see, the problem with that is that when you do that, so now we've got an increased deficit. So now you're borrowing more money. So if rates go up, the cost to service that debt goes up. Right. And think about your household. See, if you're making $3,500 a month and you're spending $4,500 a month, and then you drop your pay drops to $3,000 a month, and you increase your spending, even if it stays the same, to $4,700 a month, but now you're paying 3% on the debt, and the debt goes up to 8%, your monthly payments are more expensive. Because the debt costs more. And so now what happens is you've cut revenue. So now you've got to borrow more money to pay for the money you're borrowing, and that money's more expensive. See, what is that going to do? So you've got to ask yourself, how do I protect that? So what happens if they print more money, quantitative easing, because if the true deficit, see, people don't really understand what inflation is. Inflation the classical definition of inflation has always been, up until recently, an increase in the money supply. So printing money. So when a bank creates a mortgage out of thin air, that is inflation. And so what happens is, through fractional reserve banking, money is created out of thin air. So now when you inject more money into the economy, it dilutes the value of the money that's already in the economy. Okay. And so what you're perceiving as higher prices is actually the dollar losing value. Okay. So you got to follow the bouncing ball, folks. You got to understand what's going on, because if you can't detect it, you don't know how to protect yourself. That's why you've got to understand. Mentor told me, Nelson Nash told me, if you know what's going on, you know what to do. All right. So you got to know what's going on. And so that is the problem. So you've got to be able to define the problem. As I was saying the other day, when you understand the problem, then all the solutions that you're hearing, pay off your, max out your 401k. Really, you're going to buy more stock in a top of the market that could crash. You're going to, don't get me started. All right, that was another episode. But a lot of this stuff, you can dollar cost average and all of the traditional advice it's not going to save you, because it doesn't address the dangers of markets, government regulations, taxes, inflation, and depreciation of the dollar. Right. So those are the problems that we're facing. And so you have to look at how does what you're doing protect you against that. And see, the interest rate that's set by the Federal Reserve also affects consumer debt. So the Fed continues to raise rates this year. So here's how it affects you, right? So as well as in 2019, 2020, expect the cost of your borrowing to go up. Okay. And so according to Ian Shepardson, the chief economist at Pantheon Macro, markets are underestimating the risk of interest rate rises. Right. And believes that we could see 4 interest rate increases this year alone. And so the Federal Reserve policymakers have suggested just 2 more rate increases this year. But they are ready to act quickly if inflation jumps up higher than expected. Like they feel they can control it. The ultimate hubris is that you think that 12 people in a room have the ability to control individual actions of an entire economy, central planning. And so how do higher interest rate affect your debt? Well, think about this. So if you have a fixed rate, such as the federal student loans, fixed rate mortgages, basically that's going to remain unchanged. So if fixed debt is not going to change. Matter of fact, inflation helps you if you've got fixed rate debt, because it makes the debt less expensive to pay back. That's why, certain types, that's why I say there's good debt and bad debt. And so in a hyperinflation, or not even hyperinflation, inflationary environment serves the debtors, right? This is why the government will try to keep the debt down. And so what you want to do is align your interests with them, because they have to keep a lid on the debt, because they won't be able to try to anyway, if they can, because they won't be able to service all the debt that they're creating. So that's a problem. So you got to ask yourself, if that happens, how do I protect myself? What asset classes benefit from inflation, interest rates going up, from inflation, increasing? What could you be in that would protect you and or grow your, move your cause forward, right? So you have to ask yourself those things. Give me a call if let's talk about it. So now he'll be affected. So now if you've got variable rate debt, you could be affected, for example, with credit card debt. If you could see, If you've got credit card debt, see, that's tied to the fund's the reserve's prime rate, right? So they will tack up a little bit, right? Most private student loans offer a variable rate, and the interest rates will gradually increase. Auto loans with fixed rates will remain unchanged, but may rise if you have a variable rate. And what will happen is, if you're needing in the future to get a car loan, if your credit's challenged, you will pay more for the money, because see, if your credit's bad, they charge you a higher rate because they see bad credit, meaning you're not paying your bills or what have you, or you haven't paid your bills, or you had some stuff that affected your credit. That is how they determine what kind of risk you are. And so interest rate is a function of risk that they perceive you to be. So if you're a risk, they're going to charge you a higher rate, okay, to compensate for the risk that they're taking by loaning you money. All right. And so one of the things is, when we talk about the strategy of becoming a banker, so you have to learn with your money, as we get your plan working, to think like the bank. They just don't loan money out willy-nilly. You've got to preserve your capital. You have to be prudent. Check out The Richest Man in Babylon, the 5 laws of gold. Start to understand your money. I think that might be my next podcast, actually. And so the 4 ways to optimize your loans to prepare for upcoming opportunities. So, Curtis, what should I be doing? So first thing you can do, I'm going to give you 4 things that you could do, that you should be doing. 4 ways to optimize your loans and prepare for upcoming opportunities. So one of the things that first thing you should do is you need to find out your credit score and then work on improving it. Okay. And so it's been shown that a 720 or greater score gives you the best possible interest rates, which will be increasingly important in the future. And so here's a couple of ideas behind that. So if you, once you know how the FICO score works, one thing, so that most people are like paying people to do their credit. I'm going to give you at the end a link to something where you can kind of work on it yourself. But 65% of the credit score is things that you control. So 35% of the credit score is payment history. So some of that is just maybe putting on automatic pilot, on auto draft, at least for the minimum balance, so that you're not late, because late charges make up 35% in score. And sometimes you have the money, you're just busy, and they try to, I hate to say this, but they, you get this, the way the billing works, they almost want you to be late because they charge you extra, they might charge you extra, $15, $20, $25 late fees. And, because banks are in the fee business now, for real. And so 30% is debt ratio, right? So I was just looking at somebody's report, and they had, I want to say $1,000 balance, not balance, limit, and it had a $850 balance. So now they're at 85% loan to value. Well, the FICO score penalizes you if you're over 30. So what to do? Well, you've got to either raise your limit if that's possible, or the main thing you do is pay your balance at or below 30% of that. Or in that case, of $1,000 limit, your balance should be $300. And so just by doing that, you can drastically improve your score almost overnight. Okay. So that's a couple of things with the credit score. So you have to, you got to manage your credit. All right. And not so you can go out and go buy dumb stuff. It's really, you want to, in this environment, our money is debt. So you need access to other people's money for your investments. You got to learn how to use debt to buy cash flowing assets. So for one of the things you got to do to be able to do that is get your financials right. Okay. And Two, you want to look for lower interest rates. So if you got credit cards or loans, this could be as simple as just giving them a call and negotiating a lower rate. You can shop around for other cards, lines of credit and loans, And so, a lot of times you can call them because, they want the payment. They don't want to lose. It's very competitive. So they don't want to lose a customer. So they may negotiate or waive service charge fees if you've been a good customer and, in good standing for a long time. Restructure your loans to get a fixed rate. So Kevin Leary, aka Mr. Wonderful from Shark Tank, says this, the number one thing you can do for your peace of mind is knowing that your monthly payments won't jump up and hurt your cash flow. It is well worth any slight increase in interest rate today to lock it in. So if you got to get a little bit higher rate, if rates are trending, then you want to lock in a long-term fixed rate as long as you can. And number 4 is get prepared to borrow before you need it. I always tell people you got to borrow money. Don't money people that don't need money. And so what is that old saying? The bank is a banker, somebody that will give you an umbrella when the sun is out, but take it back once it starts raining, right? And so you've got to borrow money before you need it. So you want to get, if you qualify, home equity lines of credit or lines of credit. And the first best thing, so it's a combination because you need both, is to set up your privatized banking system. So, we teach using permanent life insurance with a dividend paying company is the best place to store cash. So, check out my interview with Jeffrey Reeves on Money for Life, but you want to be the bank. And so you've got to save money and you want to be a creditor, not a debtor. So if you have $25,000 in your banking system and you decide you want to go out and, get $10,000 worth of debt, well, you're not in debt. You have debt. See, debt is when you have more liabilities than assets. So you really got to understand, the key is control. So if you had a job loss or some business slow down, if you got enough money in your banking system, then your bank can pay off the bank, Citizens or PNC Bank, and you buy back that cash flow and you control it. So you want to use other people's money, but you need to be in the power position where you're borrowing out of opportunity and not out of necessity. Okay. And most importantly, if there's a downturn, there's two sides of every coin, right? So you got to play defense to protect yourself, but at the same time, you want to be able to go on the offensive. And so for business, you might be able to buy business equipment. Somebody's going out of business, so you can get their equipment for 20, 30 cents on the dollar, or buy up one of your competitors or something. You want to be able to gain market share. You want to be able to be aggressive. You need to be able to be attacked, to attack, right? Real estate, what happens if market crashes? That means real estate's on sale. So if your numbers work, then you need to be locking in long-term rates and looking for other opportunities that might present themselves for people that, didn't position themselves right and got caught when the music stopped playing without a chair, to quote musical chairs, right? And so as you always want to keep your eyes open. And when you see something that fits your money rules or your investor DNA, you need to be in a position so that you have the liquidity and the access to cash to move forward. All right. And so that's I just want to do a short episode. So that's it. So we talk about, the 4 ways you want to improve your credit, look for lower rates, restructure your loans to get a fixed rate, and get prepared to borrow before you need it. So you want to work on your personal economy. You want to make sure that you're saving money. You want to put yourself, we talked about this before on the 10-20-70 rule for paying off debt, but you want to be able to, while you're eliminating your non-preferred debt, your bad debt that you pay for, you want to be saving money at the same time so you improve your financial position. So for those of you, so I'm throwing an offer out here, that we have an affiliate program that we're working through, and it's called the Smart Credit Repair System. So it's part of a membership I have, and which the membership is like $35 a month. And it's a link to it, I think, if you get this email, the bottom of it. But there's I'll put it in the show notes, called the Smart Repair Credit System. It's just a one-time I think fee of $9, and what it's called the 750 credit plan. So here's what's included in your Smart Credit Repair Kit: 26 step-by-step repair, how to repair your credit videos, so you can do this yourself. You get 4 rounds of dispute letter templates, right? So you can you see a negative, you want to be able to send them and dispute it. And if they don't reply, they have to take it off. See, so there's laws around this stuff. You just need to know the rules of the game. There's ways to, show you how to reestablish new credit. See, one of the things you don't so much as fix your credit as that you need to get new things going on. You need to build your credit, right? And then we're going to teach you also in the same course about income shifting strategies for producing increased cash flow, minimizing your expenses through proper cash flow management. We're going to show you how to eliminate debt and, in it, because all this stuff needs to work together. So this is a course out there. I'm going to put it in the show notes. You can check it out and let me know if you have any questions. And so that is it. So reach out to me, guys, if you have any questions about what we talked about today. You can shoot me an email at kurtmay@gmail.com. You can give us a call at 610-622-3121. You can go to the website, practicalwealthadvisors.com. And if you got any questions, just, we have a account. We try to make ourselves available to answer questions. So you can go right on there and schedule a 15-minute no obligation appointment, and you can talk to me about wherever you want to talk to me about. practicalwealthadvisors.com. Please leave me listen, like, and share. Leave me a comment in the show notes, or email me with any questions or topics of things that you want to talk about. This is Curtis, and I'm wishing you a great day and have a great and prosperous week. We're out. Thank you.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.